Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, Financial Enhancement Group. Thankfully, you gave us a few minutes of your time this week. I've also got Andrew Thrasher, our Portfolio Manager and Chartered Market Technician. Andrew, any opening comments you'd like to make before we drill into the material this week?
No.
Get right,
no,
get right in it.
There's a lot to unpack. It's been a very exciting year. Lots of news headlines. Continue to get some economic data. Inflation continues to be a key topic and something we'll probably be talking about a little bit today. But I think we got a lot to unpack, so we can dive right in.
All right. So the topics, we actually just got 3 for you this week, but they are only 3 topics, but all each pretty significant. The first is going to be yield curve indicator, something that comes up every once in a while, and I'm sure if you haven't heard of it, I'm sure you will be at some point in time. The Great Resignation, and then cyclical versus defensive, something Andrew digs into in his weekly newsletter often and points out at times of significance, which we seem to be in right now. So let's start with the yield curve indicator. What we're looking at here by the yield curve is simply the difference in interest rates. So the United States Treasury issues its bonds in different maturities. They will issue some in short term. Think of it as like we may take out a shorter loan for our cars and a longer one for our mortgage. The U.S. government borrows along a variety of different time scales there. So one of the keys is a 2-year note and another is the 10-year. This chart measures the difference between the two. In a normal and healthy environment, the interest rate or the yield would be more on that 10-year note than it is the 2-year. The investor that's lending the money or buying the bond has got a longer time frame that the money is going to be out there. So they should be compensated for that extra risk, particularly for an extra 8 years in which an episode like this of inflation can materialize. But nevertheless, what we see right now is a period where we have very closely and briefly last week an inverted yield curve, which simply means that the interest rate of the costs on a 2-year note were more temporarily than they were on the 10-year. Now, the significance here is that throughout history, this has signaled, not immediately, but at least around the corner, recession. That has been a pretty consistent and reliable indicator and something that feeds our risk barometer. I will tell you that there's a variety of different ways that we can measure the yield curve. We look at a slightly different one and one that has a better indication of where the Federal Reserve is. Usually they will move together. I will tell you right now that one is still a little bit steeper and hasn't materialized. But there's always a few points we want to make with this. Number one, it's not a very great timing indicator. Oftentimes it could take a long time for this to work its way through the economy, and markets can continue to go up for quite a way. So this isn't the end all, but it is something to be taken absolutely serious. And even if it doesn't stick here, the odds would have to be incredibly good that it does get and stay inverted for a material time frame, just based on where the Federal Reserve is going with 6 or 8 rate hikes to go. So, Andrew, anything else you'd like to add to the yield curve thing that they should know?
Yeah, I think the couple points I would add, Adam did a great job describing the yield curve and its implications. Some of the other points I would attach to that is the yield curve can be viewed somewhat as a sentiment indicator of kind of how the financial market is assuming how the economy will perform over a longer period of time. Like Adam said, it's not a great timing tool. Typically, historically, the lead up to a recession can be as short as 6 months, up to I think the longest was like 33 months. To take something that's happening now and wait pretty much over 2 years, that's a pretty wide span. And the reason that it will invert is because of the economy believes, or traders in the market believe, that the Fed will have to begin to cut interest rates down the line. And the only reason they'd be cutting interest rates is because they see economic growth slowing, or if not contracting. So I think this gives kind of an idea of what the sentiment for the fixed income market is. The other point I'd put on there is that the fact that we've had so much quantitative easing, so much stimulus coming from the Fed, that's helped kind of keep higher interest rates lower. Imagine playing basketball and someone lowers the goal for a 2-year-old to shoot a basket. 2-year-old being the 2-year note. It's much easier if you lower that goalpost down several feet for them to be able to make a basket. That's similar to kind of what the Fed's done with how much quantitative easing and putting their kind of foot on top of the interest rate yield curve already, by flooding the market with all these additional dollars through stimulus. And so I think that's also what's helped cause this inversion right now. We'll see lots of headlines. There'll be a lot of people that say it's outright dismissal. We shouldn't be watching the yield curve. Other people use it as the holy grail. I think at FEG, we fall somewhere kind of in the middle. We think it is a useful tool. It's not the only tool, but it's definitely something we want to keep an eye on as part of a full basket of different indicators and gauges we have at our disposal.
Yeah, absolutely. The last and final touches, and I've said this many times through history, probably around previous inversions. One of the reasons, there are many other signals that have, can have a reliable forecast, and for whatever reason it breaks down and it changes, let's say this time. The reason the yield curve, in my opinion, has been a consistent one is simply what happens to financial institutions. Banks borrow money at the shorter end, and they lend out over a long period of time. So if they're borrowing over a short period, and so their borrowing costs are essentially equal to what they're getting longer term, they want to contract, and they don't want to be as aggressive. And this is a highly leveraged economy. We rely on a lot of credit. And so they begin to claw back and take less risk. And so that then eventually sinks into the real economy, and there's a slowdown somewhere, some way. I think that's why that's been so reliable over time. And it's not a great timing tool, but the teeth come out at some point. Next, the Great Resignation. That has been a term associated with a post-COVID environment where a lot of people were sent home and for one reason or another liked it and either stayed there with a work from home status or created a small business on their own or simply retired. And so we saw a significant amount of people fall out of the labor force. And that is what we're looking at here, the labor force participation rate. The initial shock there in 2020 was of course, the COVID decline. Those are a lot of people dropping out of the workforce. We had the post-COVID recovery, and then we kind of went sideways. And that was why we began to scratch our head and eventually come up with a title there, Great Resignation. And there were several things going on. Number one, there was some element of people taking an early retirement. We've got a lot of baby boomers who were just a year or two and probably decide for health reasons or one other. I know there's one or two you watching. We've had conversations where you decided to take a year or two earlier and retire. Another reason could be COVID long haulers. It's turned out there's been a pretty large number of people who had their health keep them from getting back to work. And of course, we had home daycare and other issues as schools were choppy getting back to work. So a whole host of issues kept people from coming back to the labor force. We're finally beginning to see that change and have a significant number of people back into the labor force. So I would label this certainly and absolutely as a good thing. If nothing else, to help with some of our supply issues. Just simply having people come to work and be able to wait tables or help fill the assembly line for a whole host of reasons. This is a good thing. It's where we've seen jobs numbers be really good over the past several months. A couple of things, the unemployment rate's been low and people are coming back. So we don't want to put too much weight on this because it's not that much of a forward-looking indicator. I think it just has extra potential at this point in time to helping that inflation. Anything we could throw at helping some of the supply issues will take. So over to you, Andrew, if you've got anything to add. I know it's kind of economic and not your favorite wheelhouse, but it's one of the more important themes of our time.
Yeah, no, it's not market related. You did a great job covering it. No additional topics from me. No cherries I can put on top of that one.
Oh, well, then this last one is for you. Cyclical versus defensive. Taking a look at intermarket relationships.
There we go. Now we're back to the market. That's my cup of tea. So what we're looking at here, we've got 4 lines. It looks a little busy, but I promise you it's very simple. On the top, we have the S&P 500. Then we have a basket of cyclical stocks that are pretty economically sensitive. Think autos, consumer goods, transportation stocks, energy stocks. Then we have defensive stocks, healthcare, utilities, telecommunications, consumer staples. A little bit more defensive, lower beta, lower risk. Stocks that do well regardless of economic times. And then below, we just have the cyclicals divided by the defensives. When that bottom line is going higher, it's telling us that cyclical stocks are doing better than defensive. And that's a good risk on, a high risk appetite for the market. Traditionally, we see equities do well in that type of environment as the more economically sensitive stocks are outperforming those defensive stocks. Except when that line starts to go down, that's telling us that cyclical stocks are underperforming defensive stocks, and that investors are showing a stronger preference to be more defensive, maybe decreasing that risk appetite a little bit. We can see that since the start of the year, we've been seeing that decline in that bottom panel where cyclical stocks are underperforming defensives, and we're really starting to see a really strong boost higher in defensive stocks. If we again look at that third from the top, we can see that green arrow pointing up for defensive stocks. It's almost back to its 2022 high, ahead of the cyclicals and actually ahead of the broad market as well. So we're really starting to see a strong move more to be defensive, even though we've seen where the broad market has rallied here recently, had a strong performance in March, but it seems to be a lot of that was more on the back of defensive equities than really those economically sensitive areas of the market. So something we want to watch as we start seeing the market make different moves. We want to know, is this being driven by an increase in risk appetite, an increase in risk taking by investors, or is it be investors that are decreasing the risk taking actions within their portfolios? And right now it looks like it's more of the latter, a little bit of a decrease in risk appetite. While maybe they're still trying to get some equity exposure, they're doing it more through defensive parts of the market. So something we want to keep an eye on as we continue to see if stocks do continue to rally, or if we do want to fall back to those March lows. We want to know where the leadership is in order to best position our portfolios and see how the broad market's also trying to position theirs as well.
Excellent. Well, good deal. Thank you for that wrap up of intermarket analysis, and thank you all for watching. Don't forget to give us a call, schedule a meeting, and we look forward to seeing you hopefully at either a live Thirdly or a digital one, or just come see us. Schedule this meeting, 800-928-4001, or scan the QR code to tee that up. And then lastly, don't forget our radio show, which we provide to you on a weekly basis, either over the airwaves or via podcast. So thank you again, and hope everyone has a great weekend.